Gold is respected throughout the world for its value and rich history, which has been interwoven into cultures for thousands of years. Coins containing gold appeared around 800 BC, and the first pure gold coins were struck during the reign of King Croesus of Lydia about 300 years later. Throughout the centuries, people have continued to hold gold for various reasons. So now I will share with you the top 8 reasons you should own gold as of yesterday. Number 1. A history of holding its value. Unlike paper currency, coins, or other assets, gold has maintained its value throughout the ages. People see gold as a way of passing on and preserving their wealth from one generation to the next. Number 2. The weakness of the US dollar. Although the US dollar is one of the world's most important reserve currencies, when the value of the dollar fails against other currencies as it did between 1998 and 2008, this often prompts people to flock to the security of gold, which raises gold prices. The price of gold nearly tripled between 1998 and 2008, reaching the 1,000 an ounce milestone in early 2008 and nearly doubling between 2008 and 2012, hitting around 1,800 and the 1,900 mark. The decline of the US dollar occurred for a number of reasons, including the country's largest budget and trade deficits and a large increase in the money supply. Number 3. Inflation. Gold has historically been an excellent hedge against inflation because its price tends to rise when the cost of living increases. Over the past 50 years, investors have seen gold soar and the stock market plunge during high inflation years. Number 4. Deflation. A period in which prices decreases, business activity slows, and the economy is burdened by excessive debt has not been seen globally since the Great Depression of the 1930s. During that time, the relative purchasing power of gold soared while other prices dropped sharply. Number 5. Geopolitical uncertainty. Gold retains its value not only in times of financial uncertainty, but in times of geopolitical uncertainty as well. It is often called the crisis commodity because people flee to its relative safety when world tensions rise. During such times, it often outperforms other investments. For example, gold prices experienced some major price movements last year in response to the crisis occurring in the European Union. Its price often rises the most when confidence in governments is low. Number 6. Much of the supply of gold in the market since the 1990s has come from the sale of gold bullion from the vaults of global central banks. This selling by global central banks slowed greatly in 2008. At the same time, production of new gold from mines have been declining since 2000. According to thebullionvault.com, annual gold mining output fell from 2,573 metric tons in 2000 to 2,444 metric tons in 2007. It can take from 5 to 10 years to bring a new mine into production. As a general rule, reduction in the supply of gold increases gold prices. Number 7. Increasing demand. In previous years, increased wealth of emerging market economies boosted demand for gold. In many of these countries, gold is interwoven into the culture. India is one of the largest gold-consuming nations in the world. It has many uses there, including jewelry. As such, the Indian wedding season in October is traditionally the time of year that sees the highest global demand for gold. In China, where gold bars are a tradition for savings, the demand for gold has been steadfast. Demand for gold has also been great amongst investors. Many are beginning to see commodities, particularly gold, as an investment class in which funds should be allocated. In fact, the SPDR Gold Trust became one of the largest ETFs in the USA, as well as one of the world's largest holders of gold bullion back in 2008, only 4 years after its inception. Number 8. Portfolio diversification. The key to diversification is finding investments that are not closely correlated to one another. Gold has historically been a negative correlation to stocks and other financial instruments. Recent year bears this out. The 1970s was great for gold but terrible for stocks. The 1980s and 1990s were wonderful for stocks but horrible for gold. 2008 saw stocks drop substantially as consumers migrated to gold. Properly diversified investors combine gold with stocks and bonds in a portfolio to reduce the overall volatility and risk. The bottom line is gold should be an important part of a diversified investment portfolio because its price increases in response to events that cause the value of paper investments, such as stocks and bonds, to decline. Although the price of gold can be volatile in the short term, it has always maintained its value over the long term. Through the years, it has served as a hedge against inflation and the erosion of major currencies, and this is an investment worth well considering. Today has never been easier to own physical gold. You can go down to your local coin dealer and start off with a gram for under $50, or you can go and visit goldmoney.com and set up a free account and get started there. Either way, a single gram starts you on the way to getting back to sound money practices. Enjoy.